You're watching Mirror 7 News. Stay informed, stay ahead for more news.
Hey, have you heard about the Reserve Bank of Australia's recent move? Just today, the RBA decided to cut the cash rate by 0.25%, bringing it down to 3.6%. It's a small cut, but it tells us quite a bit about where the economy is headed and what the RBA thinks about inflation and growth. Let me break it down for you in a way that makes sense. So, the RBA doesn't make these decisions lightly. Before each rate change, they release a detailed report called the Statement on Monetary Policy. This document is basically the behind-the-scenes look at how they see the economy shaping up. Things like inflation, employment, consumer spending, and more. And from the latest statement, there are some key hints about the future. Even though interest rates are starting to come down a bit, the RBA's inflation forecasts haven't really changed. They expect inflation to stay around 2.6% for the next couple of years, which is right in the middle of their target range of 2-3%. The market seems to agree that rates will settle near 3% by the end of 2026, maybe even edging up slightly again after that. This means the economy is thought to be able to handle interest rates around that level without inflation running wild. What's interesting is that the RBA acknowledges that demand in the economy is still stronger than what the supply of goods and services can keep up with. That means there's still a bit of tightness in the labor market and the overall economy, which is why rates can't just plunge down quickly. They need to stay somewhat restrictive to keep inflation in check. Another piece of the puzzle is productivity, which is basically how efficiently the economy can produce goods and services. The RBA has downgraded its expectations for productivity growth to only about 0.7% per year, which is quite low. This has a ripple effect. Because productivity isn't improving much, wages and household incomes aren't growing fast either. In fact, many households have been saving more instead of spending, which ironically helps the RBA to lower rates a bit since consumer demand isn't skyrocketing. One unexpected challenge mentioned in the report is how rising software prices might be eating into productivity gains. It seems that tech companies, especially big US ones, are capturing a lot of the benefits from technology improvements, and that might be holding back productivity growth here in Australia. Overall, the RBA is cautious but hopeful. They're watching global uncertainties like trade policies and economic risks overseas, which could still shake things up. While some signs show the labor market easing and incomes picking up slightly, the bank is ready to act if needed. So what does this mean for everyday folks? For borrowers, this small rate cut is good news. It could mean slightly lower mortgage or loan payments soon. But don't expect massive cuts just yet, because the RBA wants to make sure inflation stays under control. For savers, it means rates might stay relatively low for a while longer. And for the economy as a whole, the message is that the RBA is aiming for a balanced path, supporting growth without letting prices get out of hand. In short, the RBA's latest moves suggest a steady but cautious easing in interest rates, with inflation expected to stay tame. It's a delicate balancing act, and the bank is watching closely to adjust as needed. So keep an eye on how your own finances react in the coming months. This rate cut could be the start of a more gentle economic environment ahead. Stay subscribed for more videos.